Good morning, good afternoon, or good evening, and welcome to the TGI. Thank God it's Friday, the 2nd of June. Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. TGI Friday, helmets and goggles, payroll day. Already all set, I hope. We're going to go for our usual regular run through in here today. Calendar, what we've had, what we've got coming up. We'll take a look at some articles from the major news wires, and we'll take a quick look at the charts, but nothing really more to say about the charts apart from bull. Right, let me take a look first of all at the calendar. I'm going to actually switch back to yesterday. So we did get the ISM data yesterday, slightly below expectations. We're actually where are we on the man? Here we go. So slightly below on the S&P global data in here, which comes out at 9:45 Eastern yesterday, but only by the smallest margin, 48.5 expected 48.4, and then we get the ISM data, the main data in here. 47.0 expected 46.9, so it's hardly a disaster, slightly worse than expected. The ADP employment data, incidentally, much better than expected. Now, in some ways, previously, and somewhat counterintuitively, a bullish employment number, like a strong employment number, markets were previously reacting negatively to it because it was seen that the positive, a positive employment number equals a tight labor market, equals upside pressure on wages, equals upside pressure on inflation. I think we've shifted away from that now. I think the market now feels this way. The market now feels, okay, we're going to have a positive, if we have a positive employment number, yes, it could be slightly put upward pressure on wages. But generally, inflation is coming under control and inflationary pressures are falling. We don't have an aggressive upward pressure on what prices from wages. And then what we're going to see then, what we're really focusing on is a stronger labor market equals a stronger consumer. A stronger consumer equals a stronger economy, equals positive for corporates, positive for stocks, positive for the equity markets. So I think in here, positive for employment, a positive number like this we saw from the ADP number, expected at 170, came in at 278, is seen as a positive overall. So I think again now that's just a forerunner going into today. We also had Harker speaking. I will talk about Harker as we go forward. Harker is a bit of a dove, was fairly dovish, but the market liked that. Okay, so we'll take a look at that from in some of the articles as we go through those. Looking ahead today, look, very little coming out this morning. In fact, nearly nothing. It's all going to be about the employment report. Here's the employment report, all the different data. Remember, it's not just the NFP, the non-farm payroll segment of that employment report. Expected at 180. Now, although it says 180 in here, given yesterday's stronger than expected ADP, my feelings are that you have to put that price that in. So the market's already probably expecting this to be above 200 now, right? We're probably expecting 200 given the ADP number. So above 200 is more positive. Below 200 is probably a negative. Around 180 to 200 is probably okay. Below 150 is probably a negative. And actually, I think the market will take that as a negative. It's not going to be, well, that's okay because it's non-inflation. It probably means, actually, maybe we're going into recession and the market won't like that. If it's too high, though, you don't want it too much above 250, 260, 270, because we're up there, even though the ADP number was up there, that's going to say, well, actually, the job market stays really tight. A tight job market could be inflationary. So you probably want it above expectations, but not too much above, not too hot, not too cold, just about right, like the Goldilocks story. Okay. And then that's what we have, the real focus today. Don't worry about any of this. The other thing to note, though, we do have over the weekend, and I'll talk about it shortly. If you're trading oil, but obviously it's not going to impact us right now. But if you be wary as you come back on Sunday night, Monday morning, is that we do have the OPEC Plus meeting over the weekend. So that's the other thing to remember on the calendar. Whilst we're talking about the calendar, here comes the lecture. Get ready, strap in. Here comes the lecture. You guys who come on the calls, I'm sure, are good. Although we've had a lot of people sign up with our sale over the past week in here. If you are new to Trade Day, right, it's in the FAQs. It's in the anywhere you look when you come to sign up. If you sign up blind, don't sign up blind. Know the rules. Okay, one of our rules is don't trade off of our tier 1 data. What is one of our tier 1 data? The employment report is one of our tier 1 data. What does don't trade over it mean? don't have any orders in the order book, don't have any open positions 2 minutes before or 2 minutes after. It's coming up in less than 1 hour, 55 minutes now, right? 2 minutes before, 2 minutes after, no open positions from into or through the employment report. If you do have any, you will be fouled. You'll see your evaluation stop and you will be fouled on the evaluation. Okay, that's a hard rule, zero tolerance. Okay, I know you guys probably come on the webinars know this. I know you're probably tired of me moaning, but you know what? Every time we have a tier one data, and it's not like we have hundreds, we're not that strict, right? There are 2 pieces of data, unless you're trading oil or gas or agriculturals, right? There are only 2 pieces of data. What are those 2 pieces of data? The employment report and the inflation data, the 2 most important pieces of market moving news, okay, that we get pieces of data, okay? Those are the only 2 pieces of data. The other 2 events are the FOMC meetings themselves when they announce, only when they announce, not during the news conference, just 2 minutes either side of when they announce, and the meeting minutes, 2 minutes either side of when the meeting minutes are released. And they only happen every 6 weeks, right? So there's only those events. That's all there are. We're hardly massively restrictive. And why do we have it? Well, go read the FAQ while we have it. This is not the time and the place to go for all that. That's the rules. Follow the rules. People, we found dozens, literally dozens of people on the last employment report, on the last FOMC, on the last CPI report. Okay, it's getting fewer than previously, but we're getting a lot of people foul, and we always get questions: why have I fouled? Why have I fouled? Know the rules. Enough of the lecture. I'm sure that everyone who comes onto these webinars knows the rules, and you're good students, and you're on listening to me, so you know when the employment report is. It shocks me that there are so few people who are trading. If you're trading off 1 minute, 2 minute charts, you should 100% know when the big pieces of data are out. They're going to shift the market potentially massively. Okay, so even if you're a technical trader, I'm a technical analyst. I've been doing this for 30 years. I know when all the data is as well. It's no excuse, right? Lecture over. 5 things you need to start your day. Nothing really significantly that you wouldn't expect to be in here. We have awaiting the jobs report. Okay, we've already spoken about the jobs report. A talent war going on for the best best traders amongst the big hedge funds. Nothing that really concerns us, I would have thought at the moment. The debt deal in here goes through the Senate. Okay, done. But really, the big hurdle was the House. We're already through the House. It's through the Senate now. It just needs to be signed in by Biden. And then futures upbeat. We're in risk on mode. Big risk on mode day yesterday. Risk on. Remember, traders willing to take more risk. Stocks up, dollar down, gold up. Why is gold up? Well, gold's up not as a safe haven. Gold's up because the dollar's down. Okay, so dollar down. There's an inverse relationship there. Commodities up as well. Oil rallying higher as well. So we're in risk on mode overnight as well. We'll talk a bit about that as we go forward. So nothing too much in there. I'm going to do a whistle stop tour through these articles in here because they're all saying the same thing, really. So Senate passes the bill, debt ceiling, that's off CNBC. Stocks gain ahead of key US jobs date. We've already spoken about that. Dollar down. Harker. So Harker on the wires. A dove, though, being dovish, not massive deal. The other thing I haven't mentioned yet, China considers property stimulus in here. So China economy is continuing to be relatively negative. So China considering a property stimulus, going to boost the economy with that. Hong Kong shares did. The Hang Seng was up 4% yesterday, okay, or overnight. Your overnight, my overnight. Hang Seng rallied 4%. The Nikkei as well. Asian stocks doing well. I'll come to talk about that shortly. FOMC. So we mentioned this in here. Harker is a dove. Here's the Hawk Dove sheet. You can go and get this in our trading tips and advice. You can go and access all of those. We've got loads of good stuff in there now, guys, coming out regularly with this. So I'll go and show you where that is actually quickly. So either on the Trade Day homepage, in here, if you go to tradeday.com and you go to the bottom on the homepage, okay, so it's trading tips and advice. Oh, there's our Memorial Day sale. Remember, last day for the sale, by the way. If you last day for the sale today to sign up, right? Trading advice and tips, you can get into it here. Okay, and there's loads of stuff in here. Like, this is questioning the bull run. The article I put up in here, questioning on how far the Nasdaq bull run is starting to look a little bit tired. Although we made another new high yesterday, right? So have a look at that one there. What else? The other way to access it, if you're in the members area, you're in here. And I go in here to the members area. Now I'm going to have to be a little bit careful in here. Oops, sign in. should be signed in because otherwise I wouldn't be able to get to the calendar. So in here, I'm going to have to be quick. I was going to hear myself. In here, you scroll down here, look, advice and tips. Get rid of myself. Trading advice and tips, and then if you go in, click in here, and you can access it there to the same page. Okay, so that's how you go and get to. There's loads of stuff in here. Have a look through all that, guys, in here. Okay, we'll get the weekly macro matters in there. There'll be another one of those up later over the weekend. Okay, where was I? Anyway, so in going back in here, so yeah, Harker in here, a dove. Dove saying something dovish in here. Fed speak favouring a June pause. So he's very much focusing on a June pause in here. Where is his actual comments? I was looking at these earlier on. I've got it, I think, a little bit further along Harker's comments. So maybe they're in here. Here it is. Here, look. I think we should pause because Paul says we're going to hold for a while, and we might. We should at least skip this meeting in terms of an increase. We can let some of these things resolve themselves, at least to the extent they can, before we consider at all another increase. So Harker, a dove saying something dovish, but nevertheless it has an impact. We'll come to the CME tool shortly. Bullard, though, rates at the low end of sufficiently restrictive levels. So it's basically saying if we've got a restrictive area where rates are restrictive, we're at the lower end of that. So maybe Bullard keeping the door open to further hikes. And if we go and take a look at Bullard, though, where's Bullard? Boom, right down here, hawk. So a hawk saying something hawkish, no surprises there. What else do I have? So stock futures rise, Wall Street eyes job report. We know that in here. Traders cheer debt ceiling pass from CNBC. All the same stuff, really. Jubilant markets eye jobs in June jump. What else? It's all the same kind of stuff, really. What do I have for you here? Morning bid. Markets feel Friday cheer as signs point to Fed pause. Again, talking about Harker there. This is interesting. I'll put this one actually in the chat in here. So obviously we're looking at global national inflation rates most of the time, but world food prices, according to the UN Food Agency, world food prices fall to a 2-year low in May. So this is a positive for the global battle on inflation. Remember, the two big drivers of inflation really in the global economy have been energy and food, right? Energy and food. Energy is falling, continues to fall. The upward pressure on gas prices in Europe, the upward pressure on electricity prices in Europe is gone. The electricity prices, gas prices in Europe falling lower. That negative impact from the war in Ukraine is falling out and continues to fall out. Prices continue to go lower in Europe, where obviously we had a big spike in energy prices and electricity prices, and then global food prices on the back of that Ukraine war as well, and also supply chain issues. They are falling at a 2-year low. So that's way pre the invasion, the Ukrainian invasion, the Russian invasion of Ukraine, way pre to that. Okay, so this is definitely a positive for global inflation rates in here. Oil is rebounding yesterday and higher again today, having been selling off more recently on the back of the US debt deal, on the back of just generally we're back into risk on mode, on the back of the US dollar weakening. The US dollar weakening because, as you know, it's been rallying as a safe haven into the US debt ceiling crisis, and now the US dollar weakening as we come out of that crisis, that not needed as a safe haven. So oil prices have been rallying, but we do have that OPEC plus meeting over the weekend on Sunday. We're expecting some kind of announcement. Global, it's not just US stocks, global stocks. Japan's Nikkei hits a 32-year high. Remember, the Nikkei is still below the highs from the 1990s, okay, but pushing up into those highs from the 1990, hitting a 32-year high. Nikkei went higher overnight. I think it's up just over 1%. As we said previously, because of that potential stimulus from China, the Hang Seng jumped 4%, led by property stocks. Remember, it was a property stimulus coming out of China. European shares also pushing higher with US debt deals, Swedish real estate stocks doing well. And if we go and take a look at the overnights in here, there's the Nikkei up over 1.2% on the Nikkei, as I say, 32-year high. The Hang Seng 4% up. If we go and take a look at European stocks in here, up this morning between 1 and 1.3%. The FTSE UK, the DAX, the German, the CAC, the French, up between 1 and 1.3% this morning. And as you probably know already, we had a good day on the US yesterday, up 0.5% on the Dow. It was over 1% on the Nasdaq, not showing on here. The S&P was just shy of 1%, and the futures this morning up 0.5% across the major indices. The Dow, the S&P, and the Nasdaq up 0.5% going into today. One little thought piece I'm going to share with you. I've kind of skip read it. I'm going to put it in the chat now. This is going to be interesting. Obviously, this is the future, right? How AI is being used to help explain stock moves. I skip read it. I've bookmarked it myself. I'm going to go back and read it. Take a look at yourselves if you're interested in that kind of thing. Let's take a look at the Fed Watch tool. So you can see in here, this continues to rise in here. This is the June meeting, unchanged. 500 to 525, that's where we are now, nearly 75% now. So pretty much nailing on that we're going to be unchanged in June. But July, still expecting a rate hike, at least 25. This is this one here, maybe as high as 50, but probably 25 up. But, even Stevens between either a hike, really not much in it between a hike and leaving markets unchanged. Obviously more of a percentage risk in here over here, nearly a 60% chance of a hike and just over a 40% chance of unchanged. But by year end now, if you look, what we expect, well, this here column is unchanged. So this and to the right is unchanged or hike. Okay. And so if you look now, this is either cut. And remember, we're potentially looking for a hike by July, right? So this is looking at maybe a hike and then a cut in here. So we've got, what's this, 37, 47, 59, about 65% this way of a cut from where we are now, for rates to be lower at year end by where they are now. And we've got a potential hike in between there, right? So maybe two cuts coming in here towards the latter part of the year, in the last quarter of the year. So certainly a slightly, even the market has shifted definitely a little bit more back to more dovish with those Harker comments, with relief of the US debt ceiling and looking for potential rate cuts coming into year end. And that's kind of echoed in here on the yield curve in here. So we did get a little back up in yields, back higher yesterday at one point, but collapsing back lower. So yields continue to go down, reversing all of this higher yield move that we saw through May on the back of the US debt ceiling. This is the US 10-year yield collapsing lower again yesterday. So a very quick look at the charts in here, and it will be a quick look at the charts because there's not really much to say in here. We'll start off with the, here we are, S&P near to new highs yesterday, but on the overnight, new highs. There's nothing on here that can be, I don't see how you can look at any of this as bullish, right? We're taking out these highs now, continuing to push higher. It's just bullish at the moment. There's nothing I can say, more than that. The Nasdaq sitting right on this doji pattern high that we had in this negative gravestone doji pattern high from 3 days ago, whatever it was, the beginning of the week. That high was 14570. This morning 14565. So just stopping short of that high. Obviously it pops through there, then it looks more bullish again in here, and is the short-term chart sitting right on that high. And very high level consolidation over the last couple of hours, just sitting right on it. Obviously employment report, and obviously you're going to remember closing out all positions 2 minutes before, nothing in the order book 2 minutes before, 2 minutes after. But employment report is going to be key today. But at the moment, things are all setting up very, very positive in here. And a quick nod to the commodity markets in here. Oil, actually I do need to change the oil chart in here. So GCQ now, I believe, is front month. Oh, why is that happening like that? I don't want that. Oh no, I just go in here, right? That's why. Okay. So I'll add this in it. But if you look at gold in here, I'm going to add another one. I'll put it onto the daily. So gold, you can see benefiting from the dollar weakness we had. Go and look at the dollar index over here. Dollar index, big sell-off yesterday. Big negative candlestick 2 days ago. In here, big sell-off in the dollar yesterday in here as we go into risk on mode. And then we find that gold then does the opposite. Gold significantly up the last couple of days in here, having reversed the dollar reverse. Big bullish candlestick yesterday, sitting just below some key resistance here on the August contract, high there at 2006.2. So up through there is more bullish for gold. Just want to quickly close out these charts in here. Okay. And then we'll quickly have a quick nod at the July contract oil. So there's the rebound in oil yesterday, higher again today. No surprises for me. Look, if you look, besides this big spike down here, oil's pretty much been in here like 67 to 75 range, really. 67 to 75 range. And we're back in the middle of that range. No surprise going into a really big event for oil, the OPEC Plus meeting, that we're sitting in the middle of that range. But for today, stocks go higher, oil's going to go higher too. Right, that's all I've got for you guys. Any questions? Please pop them in the chat. Feel free. It'd be good to have some interaction, guys, but don't worry if not. Remember, no trading either side, 2 minutes either side of the employment report. Please do close all positions, close the any orders in the order book. If that's it, no questions. I'm going to wish you a great trading day. Take care, stay safe. Helmets and goggles ready for the employment report. And I will be back with you on Monday for another bull versus bear webinar. Have a great weekend. Bye.